The intraday action for Rivian Automotive Inc. is showing the stock trading at exactly $16.89 per share, representing a solid gain of 3.79% as volume begins to swell across major trading desks. Watching the action ripple through the Robinhood app and looking closely at institutional blocks hitting the Interactive Brokers trading platform reveals that this is not just another speculative midday bump. While retail traders are busy monitoring every ticking cent on the Robinhood app and tracking fast-moving options contracts, a much larger narrative structural shift is quiet taking place beneath the surface. The prevailing mainstream narrative surrounding Rivian has always been a simple story of a high-end electric vehicle startup running out of cash while attempting to build premium over-engineered trucks. The immediate reality that is completely exceeding current market expectations is that Rivian has completely rewritten its operational playbook, transitioning from a vulnerable boutique automaker into an intellectual property and vehicle architecture powerhouse that is actively subsidized by global automotive giants. Most participants in the options market and those seeking quick stock tips on public investing sites are treating this week's upward movement as a pure product hype cycle driven by the official launch of the mid-sized R2 vehicle platform. The broader expectation is that the company is simply running a standard playbook, similar to what we have seen with Tesla stock or early historical runs of Apple stock, where a new product drop creates a temporary trading spike. However, the contrarian take that serious institutional desks are building into their models on the Interactive Brokers platform is that Rivian has systematically decoupled its survival from its near-term manufacturing capacity. By securing massive equity cash injections and structuring extensive technology joint ventures, most notably with the Volkswagen Group, which recently unlocked a massive $1 billion cash transfer, Rivian has fundamentally altered its risk profile. This transition means that even if domestic mass-market vehicle demand experiences a temporary macro contraction, the value of Rivian as a software and electrical architecture licensor remains intact, completely challenging the standard thesis that this company is a high-risk cash burner destined for restructuring. Analyzing the immediate intraday trading volume and order flow across major individual brokerage accounts highlights a clear consolidation pattern above the key psychological support level of $16. Short sellers who had heavily bet against the company during its high capital expenditure phase are facing intense pressure as the technical structure on the Fidelity trading platform signals a powerful breakout pattern. Institutional accumulation has risen notably over the past 3 weeks, pulling the asset away from its 52-week lows and positioning it as a core speculative holding within modern managed accounts like Schwab Intelligent Portfolios. What we are seeing in the active order book is a distinct lack of selling pressure, meaning that current holders are unwilling to part with shares ahead of the comprehensive production ramp data. The trading velocity indicates that macro hedge funds are using advanced Interactive Brokers account configurations to execute complex volatility straddles, anticipating that the current tight consolidation will give way to an explosive multi-week directional move depending on initial manufacturing yield metrics. To understand why this current momentum is catching so many self-investing individuals off guard, you have to look at the massive gulf between retail market sentiment and the underlying corporate balance sheet transformations. For over a year, the consensus view across general online investing forums was that the company would be forced into highly diluted secondary equity offerings or debt restructurings just to keep the lights on at their primary manufacturing facility in Normal, Illinois. The reality is that management has managed to establish an extraordinarily robust capital moat, concluding their first quarter with over $4.8 billion in pure cash equivalents, and short-term liquid investments. When you add the available capacity under their senior asset-based revolving credit facility, the total liquidity cushion surges to nearly $5.4 billion. This immense financial runway completely alters the calculations for anyone utilizing deep fundamental screens on a Fidelity brokerage account or managing long-term capital allocations within high-growth Fidelity mutual funds. Let us pivot for a moment to look closely at the structural core of the business model to evaluate how these massive capital pieces actually fit together. Rivian operates as a vertically integrated automotive technology developer, design house, and manufacturer, creating electric consumer vehicles alongside dedicated commercial fleet solutions. Their signature consumer line consists of the R1T premium pickup and the R1S luxury sport utility vehicle, both engineered on a proprietary platform that emphasizes rugged utility, high-performance battery integration, and deeply embedded software systems. On the commercial side, their foundational partnership with Amazon for custom electric delivery vans provides a highly predictable, long-term commercial revenue stream that functions as a structural buffer against the inherent cyclicality of the retail consumer auto market. This commercial footprint is expanding even further through recent strategic allocations aimed at integrating advanced fleet tracking, predictive maintenance software, and dedicated logistics solutions directly into major corporate shipping ecosystems. The older financial reports and past historical performance metrics reveal exactly how the company arrived at this crucial inflection point. Looking back through prior fiscal quarters, Rivian consistently suffered from massive negative gross margins, essentially losing thousands of dollars on every single premium R1 vehicle that rolled off the production line. This structural drag was a direct result of immense fixed overhead costs, low initial plant utilization rates, and highly complex, over-engineered component designs that required intensive labor and expensive materials to assemble. During those early quarters, research and development spending regularly outpaced actual gross vehicle revenue, a reality that forced many conservative asset managers running Fidelity IRAs or defensive online investment portfolios to completely steer clear of the stock. The company was burning through billions of dollars in free cash flow annually, creating a pervasive market fear that the operational runway would completely evaporate before the company could transition to a more affordable mass-market manufacturing architecture. However, the recent structural engineering changes detailed during major industry presentations show an aggressive, successful assault on those very cost inefficiencies. Take the rear door frame of the newly launched R2 vehicle platform as a prime example of this operational transition. In the older R1 models, the rear door assembly was composed of multiple complex parts, division bars, and separate pieces of glass, which significantly escalated both material costs and manufacturing complexity. For the R2, engineers completely redesigned the frame to utilize a single, seamless piece of glass without an expensive division bar, single-handedly slashing 50% of the total production cost for that specific structural component, while simultaneously enhancing the aesthetic appeal of the vehicle. Similarly, the advanced suspension system engineered for the R2 platform delivers identical off-road performance dynamics, but costs 72% less to manufacture than the legacy suspension systems found in the premium R1 line. Comment below how many shares of Rivian you currently hold in your portfolio and whether you believe their partnership model will ultimately allow him to surpass the domestic manufacturing scale of legacy automakers. This relentless focus on engineering design efficiency is what is currently driving massive institutional interest across sophisticated investing sites and modern automated systems like the SoFi Robo-Advisor platform. The market is beginning to realize that the R2 platform is not just a smaller, cheaper car. It is a fundamentally re-engineered profit engine designed from day one to achieve structural gross profitability. By standardizing component sourcing, reducing the total number of parts, and optimizing supply chain agreements, Rivian is drastically lowering its fixed cost absorption threshold. This means the company requires far fewer total vehicle sales to reach true operational break-even compared to what legacy automotive analysts had originally projected in their multi-year financial models. This massive reduction in structural complexity is precisely what caught the attention of global automotive giants, who are now looking to license Rivian's proprietary technology for their own massive vehicle lineups. The true cornerstone of Rivian's long-term enterprise value lies directly within its unique joint ventures and deep corporate relationships, which extend far beyond basic vehicle manufacturing. The comprehensive technology collaboration with the Volkswagen Group represents a structural validation of Rivian's advanced electrical architecture, zonal control units, and fully integrated software stack. Under this massive arrangement, Volkswagen is actively deploying billions of dollars directly into a co-developed joint venture, ensuring that Rivian has the necessary non-dilutive capital to fully fund its massive mid-size vehicle production ramp without needing to tap volatile public equity markets. Furthermore, the company has significantly expanded its long-term relationship with AT&T to embed high-speed 5G connectivity and cutting-edge artificial intelligence features directly into the core vehicle operating system. This connectivity layer opens up high-margin recurring software revenue streams, allowing Rivian to monetize its global fleet of vehicles through over-the-air feature upgrades, autonomous driving subscriptions, and advanced data analytics long after the initial physical sale is completed. When we examine the broader macroeconomic pressures and sector momentum, the contrast between market expectations and operational reality becomes even more stark. The entire electric vehicle sector has faced intense headwinds over the past year, characterized by high interest rates that elevate consumer monthly loan payments, changing regulatory subsidy structures, and intense global pricing pressure led by dominant players like Nvidia stock in the tech space and massive alternative auto giants. Many undercapitalized players in the pure-play electric vehicle space have been forced to completely freeze their production expansion plans or abandon the market entirely. Yet Rivian has managed to move steadily forward, systematically executing its transition to the mass-market R2 SUV, while simultaneously preparing its massive new production plant in Georgia to achieve a staggering initial phase capacity of 300,000 units annually. This capacity expansion ensures that as the macro cycle eventually turns and interest rates begin to stabilize, Rivian will possess the necessary manufacturing scale to capture dominant market share. For active traders managing their capital allocations across modern active trading tools like the SoFi trading platform or the Fidelity mobile app, understanding the upcoming structural catalysts is absolutely essential. The market is currently laser-focused on the real-time production numbers, early customer delivery data, and reported reservation wait times coming out of the Normal, Illinois facility. As test drives and public deliveries roll out across North American showrooms, the immediate transition of speculative reservations into concrete binding vehicle orders will serve as the definitive proof of mass-market demand. Any early indications that manufacturing yields are exceeding internal projections, or that gross margins are turning positive ahead of schedule, will likely trigger a massive reassessment of the stock's valuation multiple, potentially causing significant upward adjustments across the entire self-investing landscape. Looking ahead toward potential future scenarios, the risk and opportunity matrix for Rivian remains deeply tied to the critical execution of its volume manufacturing strategy. In a bearish scenario, any prolonged supply chain disruptions, unexpected quality control issues with the initial R2 batches, or integration delays within the Volkswagen joint venture could temporarily slow down the path to profitability, causing short-term volatility that would test the patience of retail holders on the Robinhood Investments app. Conversely, in the highly probable bullish scenario, the seamless execution of the R2 rollout, combined with accelerating commercial deliveries to Amazon and new robotaxi deployment initiatives with partners like Uber, will rapidly validate the company's dual-track revenue model. By leveraging its software architecture, commercial fleet dominance, and highly efficient mass-market consumer platforms, Rivian is structurally positioned
positioned to completely transcend the limitations of a traditional hardware manufacturer. When you strip away the daily market noise and the short-term emotive swings frequently seen across general investing sites, the central insight is that expectations and reality are moving in completely opposite directions for this asset. The market narrative is still treating Rivian as a fragile, cash-burning startup vulnerable to macro headwinds and fierce sector competition. The underlying corporate reality is that of a heavily capitalized, structurally efficient technology innovator that has successfully insulated its balance sheet through massive global partnerships and world-class architecture licensing agreements. For anyone managing a serious individual brokerage account, evaluating high-growth options within Fidelity ETFs, or executing precise trades on the Interactive Brokers platform, this structural divergence represents a profound opportunity. Rivian has successfully laid the groundwork to transition from a premium niche manufacturer into a dominant high-margin architecture powerhouse, leaving the outdated market expectations far behind as the true operational reality begins to take center stage.